Hi everyone, I'm a bit overdue this week because I was kind of waiting, well, we had Memorial Day obviously, and then I was sort of waiting for more clarity on the debt ceiling negotiation, but that's still ongoing, and I'm about to go on CNBC and give a fairly bearish message. Basically, the obvious major potential turning point, which I think could actually go either way, is going to be the OPEC meeting on Sunday. Interesting news today that OPEC has not invited some of the major news agencies, notably Dow Jones, Bloomberg, Reuters. Personally, I'm not going this time, basically because we've had a couple of major announcements that really haven't come to anything, notably the October 2 million barrel a day surprise cut announcement last year amounted to nothing. And of course the problem is basically that OPEC quotas are set on production, not exports, and so you can claim to have cut production whilst maintaining exports, which is very much what the Russians are doing. And Saudi actually did the same thing last year with the announcement of the 2 million barrel a day cut. Essentially that was Saudi domestic demand fell and therefore domestic production fell. There was no impact on overall oil markets. And as a result, we find ourselves with okay inventory levels, probably slightly rising inventory levels, but at a time of year where we should be at max bullishness for the year. Typically May, June are good months for oil, but then it tends to be a weaker second half. And as far as our bull call for this year goes, which was really a last year call, first of all, winter didn't show up, and then China hasn't been showing up, and Russia hasn't gone away. And so we got out of the call well before Memorial Day, but we can't avoid the fact that this is the most bullish time of year and we're struggling to hold 70 WTI. So the setup is quite bearish, particularly as China remains seemingly quite weak. You're going to see India go through monsoon weakness. Middle East keeps coming, but Europe is obviously very weak. And as I didn't mention, we've had some weak PMIs from China. The economic data there is concerning. So the demand side is looking fairly rough, particularly in distillate, in the economically sensitive side of the market. Demand is looking distinctly weak. And whilst US gasoline is strong, US jet fuel, in fact jet fuel globally is doing very well, distillate is a hugely important part of the global barrel, and as long as it's weak, oil prices are clearly struggling to show any kind of strength. And at that point, an OPEC cut actually becomes bearish, because you simply are cutting into a weak market and adding spare capacity. Now, one wild card that I haven't heard people speak about is maybe there could be a price war scenario here. I mean, there's been a precedent. We obviously saw that in March of 2020 when Saudi incredibly took their production to an all-time record high in a dispute with Russia over volumes. And so I just don't know what will come to pass this weekend, but I do think that there is actually a major downside scenario, which is not only do they not make any incremental decision on cutting, but actually they decide to ramp up production in order to try and flush Russia out of Asian markets, which they really can't do because basically Russia's got nowhere else to go. So it's kind of a bearish setup, and I just don't know, with the credibility of OPEC Plus over the past 6 months having been damaged by lack of real cuts, I just don't know how positive this meeting is actually going to be for the oil price, and that becomes an issue for the sector. The other big news today, well, this week at least, is the permitting aspect of the debt ceiling bill, which Manchin has managed to slip in, if you want. I don't think anyone's not noticed it, but he's slipped in approval for or a change in how you permit the Mountain Valley Pipeline, which is a big deal. And we've written you a note today highlighting that will have a significant 2 BCF a day incremental gas into the Transco pipeline, which should pressure all the way back to Waha. And actually this move, if assuming this pipeline is permitted, that will put further pressure on Waha prices, which further lowers the real price that US E&Ps in the Permian are getting, particularly those that are more gassy and NGL oriented. So for example, you'll see today Devon's price realization fully built up, oil, NGL and natural gas is just around $50 a barrel, right at the point of pain when essentially the free cash flow goes away. And if, over the course of the next 6 months, if we were to get the startup of MVP, you're going to see yet more pressure on, for example, Waha Permian prices that again are going to have the effects of actually lowering the price that US E&Ps make, and therefore going to serve to further reduce activity and tighten oil markets. And so the bigger deal here over the next year or so is really the extent to which US maybe even goes into decline on oil production. given its importance in incremental production over the past 10 years, that'll be a big deal. And of course, when that productivity cycle turns and we get through the cyclicality of the assumed upcoming recession, we're going to be in a very bullish situation for oil, because essentially productivity trends are what sets the oil price, whether they're rising or falling. And clearly we've got falling productivity in global oil right now, which will be the next bull call once we get past this next recession. For us, in the short term, we're more concerned about the recession and issues with OPEC, which we don't think are very bullish. And so on a short-term basis, we're pretty bearish here. We see 60 as the floor, so watch out for that one. About $10 of downside. Anything below 60, I think WTI is unsustainable. All right, have a great day.